It's about liquidity, it's about raising money, it's about prestige and marketing, and it's about having a settled on valuation. It's challenging to go public, it's more challenging to be public. It's not about the IPO, it's about what you do afterwards. The biggest item probably is that one has to publish an S1 or a prospectus that details what the business is and what the numbers are and who the management team is and how much stock they own and lots of issues like that. Every single sentence has to be 100% factually correct because otherwise you can get sued. Today, you don't need to be a profitable company, but you need to have a very credible path toward getting there. The story has to be very compelling. So big enough to have proven you've done something, a path to profitability, growth.
Welcome to the New World Podcast, where we delve into the ever changing and accelerating pace of global change and its impact on our lives. I'm your host, John Paul Flores, broadcasting live from the New World Studio. Today, we're diving into the world of AI and automation. As an enthusiast and expert in lead generation, I will guide you through understanding and leveraging these technologies for your business and for your personal use. And don't forget, AI and automation might be unstoppable forces, but that doesn't mean you are powerless. Tune in to learn how to make them work for you and not the other way around. But first, let's meet our guest. Welcome to the New World Podcast, where we navigate the changing world around us. I'm your host, John Paul Flores, specializing in lead generation and AI automation, here to help you understand how our world is changing and what it means for you. In this episode, we have Lise Buyer, a seasoned expert in capital markets and IPO processes with over 3 decades of experience and significant roles at companies like Google and the Trade Desk, and now partner and founder at her own company. Lies will share the insights of how the fast-paced changes in the world are impacting the IPO landscape. Lies, it's a pleasure to have someone who's so experienced in this field on the show today.
Well, thanks so much for inviting me to join you.
By the way, before we go on the in-depth questions, because I do have some, do you mind giving us a quick intro on what is it you do, your expertise, experiences, and what keeps you busy these days?
Sure, happy to do so. So I spent years as an institutional investor at T. Rowe Price, making the decisions along with some other coworkers on our investments in technology companies. And we were the largest dedicated technology fund, mutual fund in the country at the time. Every IPO, every technology IPO would come by us because we made a big difference. If we liked them, the deal had a much better chance of succeeding. So saw a ton of IPOs as an institutional investor. Left because I wanted to move out to California, where the technology companies, most of them were based, and I became an investment banker. And so I got to see the IPO process from the perspective of the seller or the agent, as opposed to as the buyer, as I had been at T. Rowe. Did that for a while, left that and became a venture capitalist briefly, and so was able to see the IPO process from the perspective of a board member. And finally, I decided that I really wouldn't be a strong venture investor if I'd never worked inside a venture backed company. So I left being a VC and I went to work for a relatively small at the time startup. And there's a great phrase that is often true: I'd rather be lucky than smart. And the small startup I went to work for was a search engine company based in Mountain View, California, with a primary color logo and two O's in the middle and a G on the front and an LE on the back. So I was able to work as a project manager on that
Yeah.
company's very unique IPO. That's the background. I took the fact that I had been on the buy side, on the sell side, on the board, and inside a company, and recognized that there's a lot that management teams who are going through the IPO process just don't know. And wouldn't it be
Yeah.
nice if they had someone who was totally dedicated to what was in their best interest? So that was when I set up my own company to say, let me act almost as a caddy. I am not a golfer, but let me act as a caddy to management teams as they go through the process to help explain all the nuances, help them think through all of the options that they have, and to help make sure that we do the best job we possibly can for positioning the company for a long and happily ever after. That's kind of the long-winded story. But I now work with management teams of companies going public to help them get through the entire process of the IPO and to function more efficiently as public companies.
That is a fascinating experience that you have. I love the fact that you try to downplay Google. But were you with Google when they were on their startup phase?
When they were under, say it again.
Were you working with the company with the G and the double O when they were on their startup phase, or when they were sort of
So the
established?
company had started in, I believe, 1998.
Yeah.
I didn't get there until 2003. So we were fewer than 1,000 people, but we weren't fewer than
Yes.
100 people.
That's still a very early stage for Google.
It was a different company then than it has become. Now, what? Well north of 100,000 employees. I would say.
Imagine having 100,000 employees. You don't even know what they're doing.
No, exactly. It was a totally different experience.
By the way, you said you have experience from the buyer side of things, the seller side of things, and the board member side of things on the IPO process. What's the main difference between the three?
Oh gosh, many. Um, when you're on the buyer side, you are looking at a company for what it can become in the future. You figure you're paying full price for it today. So, as an institutional investor, I would only want to buy it if I believe there was significant upside ahead. So, that's what you're looking for. What they've accomplished is nice. What the roadmap looks like is what matters. When you are the investment banker, you are working on behalf of the client, and it's a little murkier because you maybe want to help the company get the best price it can and you're less concerned about the future. Or maybe you do want to position it for up and to the right later because that's what's going to matter to employees. So it very much, as a banker, is what is the company trying to accomplish? But the biggest clients of the bankers are the T. Rowe's and the Fidelities and the Capitals, and they always want to buy the stock as inexpensively as possible. So there is some pressure on bankers to push the pricing down. That is not always in the best interest of the company, who may be going public because it wants to raise money to build. Certainly did back in the day. Now there are more different considerations when companies are going public. So one is looking at where it's going to go. One is looking at what can you can optimize right now. Obviously, the board just wants to get it done and get it out there trading. And companies have all sorts of different motivations for going. So is it just to create liquidity for employees because they've been promised that all the way along? Is it to raise as much money as you can so you can put it in the treasury and use it to build out the company? Is it just to make a big splash so that everybody knows who you are and therefore it becomes a pretty important marketing event? Those are three of them. How much money are you raising? How much noise are you making? Are you just creating a liquid market? And what do you want the trajectory to be, because again, your current employees care more about where the stock is going than where the stock is today. So all of those are compelling reasons for companies to go.
What I find very interesting is the fact that when you're the investor, you want to buy the stock of the company at the lowest possible price. But the other side of it is at the expense of the company itself. They're not going to have as much growth ability because you're not giving them as much money. But at the same time, you want them to succeed as much, but you still want to buy the stock at the lowest price.
Absolutely. And look, different management teams look at the
Yeah.
process differently. Some want to raise every penny they can. Some just want to be sure that there's room for the stock to move up in the future. And they don't want to go at the highest price, particularly if there's a frenzy for that particular deal. So they will very intentionally, management will very intentionally price the stock below where they could sell it. And that's why sometimes you see a big pop in an IPO price. Because management said, no, I want to go out at this price that I can rationalize, and I'm going to ignore the frenzy from the buyers. So it's very different, but there are certainly a lot of things for managements to consider as they're going through the process to determine what's the optimal strategy for them.
Between your three experiences, a buyer, seller, on the board side, which one did you find most interesting or enjoyable?
Oh, tough question. I loved being on the buy side. It's challenging because you're responsible for somebody else's money. And so you want to be as difficult and as skeptical of management teams as you possibly can be, because again, it's not my money I was investing. So that was kind of fun because, as I like to joke, I loved being the investor from hell. I see what you're saying, but how are you going to do that? That doesn't make any sense to me. That was a lot of fun. On the other hand, I love what I do now because I'm helping the management teams understand what the process is like and what the long-term ramifications of their decisions are. And it's kind of fun to help companies. And of course, when companies are going public, they're almost always in a good place. And so I get it there. It's a challenging process. There's no question about that. But it's pretty exciting to see what these entrepreneurs have built and to do my little part to help the future continue to be bright. So I like that too. Probably the best
You know, in
part was my least favorite.
in the buyer side of things, I think the great thing about you being skeptical on these management teams is the fact that the more skeptical you are, the more better they are at explaining things. Therefore, they're gonna be better at what they do.
Absolutely. Again, the skeptic, and I do that still for my clients today. I will act as if I am that skeptical investor so I can throw every barbed question at them ahead of time so that they're ready before they meet the real investors who will make a difference.
For the people who is not familiar with IPO, can you explain to us how it works, what people it affects, and where it actually leads in the future?
Absolutely. So when companies first get built, they raise money from wherever they can. Often it's friends and family. Then, as they get a little bigger, they'll go out to the venture capital community and see if they can raise a little more money. And they'll do a couple of rounds, often with bigger VCs each time. And sometimes other firms, which are private equity firms, we probably don't need to go into the difference here, but those guys too. So companies just have a few investors and they don't really have to report very much. But if you are an employee at one of those companies, you can't necessarily sell your stock. If you see a house you want to buy or a car you want to buy, too bad. Your stock may have value on paper or on paper electronically, but it doesn't, you can't trade it. You can't put those dollars in your bank account. So when a company goes public, it lists on an exchange, and generally, particularly for the companies I work with, that would be the New York Stock Exchange or NASDAQ. And once a company is listed on an exchange, then you can sell the shares most every day. There are certain restrictions when individuals have non-public information, but generally you have a liquid stock and you can trade your shares for actual cold hard cash, which is handy from time to time. So it's the process of going from being owned by just a few people or a few organizations to being a publicly listed stock. And there are many SEC regulations that interact. The biggest item probably is that one has to publish an S1 or a prospectus that details what the business is and what the numbers are and who the management team is and how much stock they own and lots of issues like that. And it all has to be very precise because it is a document that is used for selling securities. And if you are selling a security, every single sentence has to be 100% factually correct because otherwise you can get sued. And so putting together that S1 or when it becomes a final document, that prospectus, is a laborious process. So
Yeah.
that's a big part of it.
Now, when there's a company that is deciding to go public, what is the generally the pros and cons of being a publicly traded company?
Let's start with the cons. Everybody knows how much management makes. A company has to report its results every single quarter. And sometimes companies want to make investments that won't pay off right away. So you have to suffer the slings and arrows of a stock that goes up and down when you make investments that the team believes are in the best interest of long-term shareholders, but may not be helpful near term. But the biggest con is that you have to publish your results every quarter, and you have to meet with investors and explain yourself to investors. That's the biggest. Those are the biggest cons. I hope that's what I just said. On the pro side, one, you get to raise a lot of money and put it in the treasury, and that can help you grow. Two, you get a much more expanded group of shareholders. And that's important, particularly if you ever want to use your stock in an acquisition. Because when you are private, let's say you have six, eight, 10 important shareholders, they can all agree that your stock is worth $36 a share. But on the other side of the transaction, somebody may think, no, it isn't. It's only worth $23 a share. You're full of nonsense. Once your stock is traded on the public exchanges with thousands and thousands of buyers, you know what the price is every single day. The market is telling you that stock is worth $32, and no other gibberish on either side makes any difference. So it very much helps if you want to use your stock as an acquisition tool. It's also nice that the stock trades every day so that employees or individuals, instead of saying, I own a lot of stock, can actually have that cash in the bank. And finally, companies want to go because it is a major marketing event. And particularly
Yeah.
if you are a rapidly growing young company and you want to do business with a big, long time established company, it's nice to have the world know who you are and to be able to say, look at my balance sheet. I'm going to be here for the long run. So
Yeah.
it's about liquidity, it's about raising money, it's about prestige and marketing, and it's about having a settled on valuation for the company and for each share.
In terms of your experience, what type of thresholds does a company need to first accomplish to actually be worthy or actually be, even think about being publicly traded?
Yeah. So it's different for different companies and it's different
Yeah.
at different times. In 2020 and 2021, really all you needed was a slideshow and somebody to say, I mean, the market was buying everything. It was a risk on market. And many of those deals worked quite well for a time. Today, you need to be a bigger company, probably $200 million dollars at least in forward revenue. There are those who say it's a much bigger number. I disagree, but it depends. Back in the day, profitability was irrelevant. Today, you don't need to be a profitable company, but you need to have a very credible path toward getting there. So you need to tell a story that demonstrates that you have a sustainable proprietary advantage. That's super important. Why am I going to buy, particularly given how well some of the big stocks, Microsoft, Amazon, Meta,
Yeah.
Alphabet, Nvidia, given how well they've all done, as an institutional investor, why should I invest in this unknown little startup when I can make money in something that I know knows how to
Yeah.
perform? So the story has to be very compelling. So big enough to have proven you've done something, a path to profitability, growth, right? Growth not doesn't have to be 50% or 60%, but north of 25 on an annual basis, and not just next year. A
Yeah.
sustainable path of that sort of growth. Those are some of the things you need. And I should caveat it that I am talking about technology companies.
Yeah.
Biotech companies, pharma companies have a different set of metrics that matter for them because obviously many of them are investing in drugs that have no revenue at this point. So I'm
Yeah.
simply talking hardware, software, things that aren't pharma.
So basically, in terms of technology companies trying to enter publicly traded, maybe Nasdaq or New York Stock Exchange. So basically, as you said, they're now more open to startups. So basically, you don't need to have huge revenues at the past. You just need to show future possible growth for a company.
With limits. It can't be, I
Yeah.
think it have for most exchanges or to get a lot of
Yeah.
interest, a company with $50 million in revenue just isn't big enough. But if it's $200 million in revenue
Yeah.
and it's growing at 30%, that is big enough, not for the biggest firms or the biggest funds. But there's a large number of investors below that threshold who would be very
Yeah.
interested. And part of the issue is that investors, institutional investors,
Yeah.
are judged on a relative basis. Did you do better than Fidelity? Did you do better than
Yeah.
Zero? And if everyone owns the
Yeah.
Magnificent Seven, the same seven stocks, no one's going to really do better than anyone else. So the new companies, the emerging growth companies, are where you get what's called alpha,
Yeah.
incremental uplift. So that's why institutions are interested because IPO
Yeah.
clients are almost always more risky than those that have been trading for a while. So if I take the extra risk, it's because I believe I'm going to get incremental reward.
Yeah. In your experience, is there a huge con when a company actually enters a publicly traded system? Is there a con where if the stock drops so low, the company just shuts down?
Sure. Sure. I hope to not work with companies that aren't stable enough. But when company, look, every employee who owns stock likes to see the value of the stock go up. If
Yeah,
your company hits a hard time, and companies always hit a hard time somewhere along the way. Every company ever has had some bad quarters. And a bad quarter or two doesn't really matter. A bad year or two or three does matter. So absolutely, if you've gone public and you're not performing, and your stock falls, A, you may have demoralized employees and they begin to look for other jobs. Two,
yeah,
there's a big risk of a takeover. Some activist can come in and say, I think we can run the company better than you're running it, and out of the way management. So that's a
yeah,
risk. When you're private, it's much harder to have that happen. Although, again, your venture investors or your private equity investors can also replace management.
yeah.
But
No, I'm very interested in that. How does an actual takeover happens? What what does it actually do?
I
Return to the
Yes. So how
question.
does the
How?
takeover happen? All kinds of different ways. There you go. All kinds of different ways. Sometimes management knows they just don't have what it takes, and so they actually invite conversations. And that can be with a strategic
Yeah,
buyer. You're a small company, and you think what you produce would really fit well inside of a much bigger company, and their
yeah,
know-how and their resources can help you. So then it's a friendly conversation where somebody calls somebody and says, "Hey, want to have a talk?" And then you have a
yeah,
talk, and then you negotiate back and forth on pricing. And assuming you can come to some sort of a mutually acceptable agreement, then all the lawyers come in and the bankers come in, and it gets all the press and the press folks come in, and it becomes a very carefully orchestrated announcement. So that's
yeah,
one way it happens. Another way it happens, and to what we were talking about a moment ago, if your company is not performing well,
yeah,
some other company or some activist investor may start accumulating your stock and you don't know. And then when they have enough, they have to file what's called a 13D, an SEC form, and they say, yo, we have a lot of your stock and we want a seat on your board.
yeah,
Or we need two seats on the board. And so then again, there will be meetings between the investors and management, and either they will go well or they won't go well at all. And then sometimes there's a proxy fight where the big investor goes out to all the investors and says, hey, we don't think this board is doing its job. Let's replace them. Vote for our
yeah.
candidates. And the company management says, no, 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 we're doing a great job. Don't vote for those candidates. Then you see investors will receive tons of information in the mail and phone calls saying vote for my side, vote for my side, and that would be a hostile. And the hostile can just be putting people on the board. It doesn't necessarily mean a complete takeover. And that's the third approach: is a big company just swoops on in with what they call a bear hug. Your stock is trading at $20 a share, and a big company doesn't think you want to get taken over, but they come in and offer $35 a share, and you have no choice. You have to accept. But to be in the state of Delaware, you must always do what is in the best interest of your shareholders as opposed to your stakeholders. So even if you believe that with time your stock would be worth more than that 35, if you get offered 35, you cannot say no. And so that's another way a takeover can happen: is a company offers a number that's so big that the liability is much too great to say no.
So it's not that they can say no. They're legally not allowed to say no.
Yeah, I mean, they could say no, but then they'd all be sued and they'd lose. So
Understand?
that's if you're incorporated in Delaware. You must
Yeah,
accept the shareholder price. If you are incorporated in certain other states, you can also consider what is in the best interest of all the stakeholders, which could
yeah.
include employees or the people who use your product or whatever it is. But Delaware says price.
I think one of my other question is that is it I don't know if this works actually. Is it possible for a big company, let's say if the price of the share is low enough to just buy so much through Nasdaq or other exchanges, and if they buy enough stock they can basically say that they should be the uh, board of the company?
No, you still have to get shareholder approval. So you
Yeah.
may, unless you own a large majority of the shares, you would still have to get approval from all the other shareholders or from a majority of the other shareholders. You can't just buy stock and say, on the board.
I mean, that's such a great move if it is possible.
Yeah, and again, you can be sneaky up to a point,
Yeah,
but then you have to file. If I'm an activist investor and I begin to buy
yeah,
up your shares and I own more than a certain amount, I have to be public about that. And then management can immediately start looking for friends or
yeah.
in what's called a poison pill, which is we used to have, 10 shares, but now each share is worth 10. So we have 100 shares. So your position is diluted. There's all kinds of moves they can make to stop you. Inevitably, you will have some conversations about what the activist is trying to accomplish. And frankly, sometimes the activists are going to make it a better company. The activists are sometimes perceived as all bad all the time, and that's not correct at all. Sometimes,
Is that
sorry, go ahead.
is that an actual occupation or title for someone activist investor, or is it just basically something you call someone who does that?
Both. There are certain firms that
Yeah,
believe that they can be most helpful by focusing on what they believe are underperforming companies. And so there are
yeah,
certain shareholders who are known as activists. If Starboard Value buys some of your stock, that's an activist. If Elliott Management buys some of your stock, you're pretty sure that's an activist and that things are going to get interesting. On the other hand, there are other firms that can act as activists but are
yeah.
less well known for that trait.
It's very interesting. And how do you actually help these companies prepare for IPO?
Whole different topic. Okay, so that has something to do with activists.
Yeah,
What we do, helping you prepare for an IPO, is first let's look at your forecast. First of all, let's talk about why you want to go. What are you
yeah,
trying to optimize for? Is it money? Is it publicity? Is it liquidity? Do you want to take something over? Because what you're optimizing for will have an impact on how you go through the process.
yeah,
Okay, let's look at the numbers and let's see what you've done. Are they big enough? And let's check your accounting and is it audited? And by the way, let's look at your forecast. Do you even have quarterly forecasts? Are they realistic? Let's look at all of that. And so we'll help them think through that. Do you have the right people on your board to be a public company? We'll help them look for incremental board members if that's important. Do you have all the right people in all the right seats? Do you have the right outside counsel? Do you have the right inside counsel? Do you have lawyers? Is your communication as clear as it should be? Do you have the right guy or woman running sales? Let's look at the entire C suite and make sure that
yeah,
these are the people you want to be with for the next, let's call it 5 years. Whether they stay or not, we can't control. But do you think you've got the right people in the right seats? And we'll look at all of that. And then we will help them prepare. Tell me your story. Tell me why you exist. And the example I often use is that um, back in the day and probably still today, semiconductor companies would be so
yeah,
excited that they could do something in 2 nanometers instead of 4 nanometers. And that was a real technical accomplishment. But from an IPO perspective, I don't care unless you tell me how that's going to help you be a stronger company. So
yeah,
meet with companies who tell you about their amazing technical accomplishments, but ask them to think about it in terms of what does that technology advance allow you to do better? How does that allow
yeah,
you to be a bigger, stronger company? So we'll work with them on telling the story clearly, and that's also very important. And then we'll help them hire investment bankers. How big a deal do you want to do? How many bankers shall we have? What kind of bankers shall we have? Who would be the best for your particular company at this particular time? There is not one right answer. And so we'll
yeah,
help them build a syndicate. And we will help them work with the bankers to make the process as efficient as possible. And then there's a bunch of little stuff along the way. There's other third parties you have to hire, and we'll help them vet those other third parties. There's which investors do you want to meet, and when do you want to meet with them, and how often do you want to meet with them,
yeah,
and then what process do you want to use to go public? Do you want to be a straight down the middle IPO? Do you want to do an auction IPO? Do you want to do something in between those? There's that kind of stuff. So long list of stuff. And then again, how are you going to tell your story to
yeah.
institutional investors once you're public?
That's a very long process. And typically, how long does it actually take to be IPO ready?
I think bankers will promise you 6 months. I think 6 to 9 months is much more realistic. And of course, for those companies that thought they were going to go public in 2022, they started the process in 21 and it's still going. But assume it's a 9-month process, and then all your surprises will be happy ones.
That's a very long time frame. And it's some kind of way, it's like preparing for selling your company, but the difference is instead of showing the investor how stable it would be after you sell it, it's gonna be on how possible growth actually is.
Yes, yes. You've got to give them a forecast, and it's got to
Yeah.
be realistic. It doesn't mean everybody makes it. In fact, probably a third of companies miss their first quarter, even though they tried very hard. But there's an imbalance because the investors are going to choose what they pay for your stock based on your forecast,
Yeah.
and so that gives you every incentive to push the forecast up, and you cannot miss that forecast, and that gives you every incentive to push the forecast down. So
Yeah.
where's the middle?
You know, what is the forecast? Because I'm shipping is all just about how much revenue you're generating, or is it also about how big the company has gotten, how many people was hired, or is it just solely about the profit?
It's much more about the entire P&L than
Yeah,
it is just about revenue. Yes, revenue growth is the single most important element, depending on
yeah,
what business you're in. But how much of the revenue you take in makes it to the bottom line? And again, you don't have
yeah,
to be profitable when you start out, when you go public, but you have to have a credible path to getting profitable, or else you'll just keep having to raise money over and over and over. So revenue is the most important, but so is the rest of the balance sheet. And if you're spending too much and not accomplishing enough, and companies that are going public are compared to companies that are already public. So
yeah.
how much do you
True.
spend on marketing versus how much do your public companies spend? How much do you spend on engineering versus how much your public competitors do? And there's that comparison. All of those
It's
things go
very
into the
interesting.
investor's thinking.
You also mentioned something about straight versus auction earlier. I don't know what they are, but can you explain them?
Sure, there are many different ways to do an IPO. Probably the details may be not as interesting to the audience, so we won't dig down too far. But there's something called a direct listing where the company doesn't actually raise any money and they don't set a
Yeah,
price. They just say, okay, we're going to start trading tomorrow, and you watch where it happens. There
yeah,
is a traditional deal. Whatever price the company is sold at is carefully orchestrated by the bankers and management. In an
yeah,
auction, it's a hybrid of the two. They take input, the company will take a lot of input from investors to see how many shares do you want at 27? How many shares do you want at
yeah.
28? How many shares do you want at 29? And they'll build an entire construct to see where the real demand is, and they'll use that to determine the price. So there's a lot of nuances, but mostly it's about determining what the price is.
It's very interesting. And I think one of the other questions that I actually had earlier is that when someone is working with a startup and you are someone in their company, they typically give you a particular set amount of stock. Does that mean that when the company goes public, you're immediately allowed to sell those stock off, or is there some kind of rule saying, hey, you're not allowed to sell those yet, you need to wait for about 5 years or something?
Absolutely right. There's something called the lockup.
Yeah,
And traditionally, lockups were 6 months, 180 days. And any employee or early investor who was not selling in the IPO had to wait 6 months. Over the last, I don't know, 5, 8, 10 years, there's been an advance. In fact, Google was early in this to do something called a staggered lockup, where, for instance, employees other than senior management can sell a
yeah,
certain percentage of the shares they own within, let's call it 30 days. You can sell 10% of your vested shares, and then you can sell another 10% in at 60 days. So they're very custom, but uh, everybody who has shares, whether it's an early investor or whether it's an employee, knows what the terms are and when they can sell, and they all have different schedules.
yeah. When an IPO is happening, there's different types of companies, especially to the point that some companies who are trying to sell might have 80% of their stock. Some companies have 15% of their stock. How much stock do you actually need to sell to maybe NASDAQ or other exchanges to be actually allowed to do an IPO?
Yeah, the answer depends a lot on how big the company is.
Yeah.
There needs to be a large enough volume of shares that will trade to make it of
Yeah.
interest to the big investors. So technically, you could go with, I don't know, 5%, 3%, but nobody would want to pay any attention because they couldn't buy enough stock to make a difference to their portfolio performance. I think the smallest I've seen is about 8%, and some companies sell 20%. So it
Yeah.
depends what kind of company, who's selling. Some of the stock being sold comes right from the treasury. It means the company gets to put the money in its bank account. Some of it will be early investors saying, buy me out of this. And it goes right in the investor's pocket and doesn't go to the company. So there's lots of different structures and nuances, again, which is why I have a job, because none of it's
Yeah.
straightforward. So that's that. There's no one answer. It's reasonable to assume 15% of your value should be a minimum of
Yeah.
what's traded. But again, the very big companies might choose to sell quite a bit less.
Is there some instances where somebody wanted to work with you, but at the end they just chose to work alone and just do the IPO themselves? And what happened then?
We sign contracts up front.
Yeah.
So
But how?
if you want to walk away from your contract, you can, but you've signed a contract that has payment terms. So it has never happened, but I have had companies that didn't go all the way to IPO, and
Yeah.
so we find a happy place to cut the contract off and wish each other well. But it isn't that we do all the work and
Yeah.
then somebody says, "Thanks for your help, bye bye." We tried to legally structure it so that can't happen. Early on, that did happen. I didn't have it structured quite correctly, and I had a company that got bought out halfway through, and I had done a lot of work, um,
Yeah.
but I didn't get paid. So now there are contractual safety valves.
But is there cases where there's not a company working with you, but just a random company who decided to go to IPO with themselves without any help
Oh,
from a
sure.
professional?
Oh, many companies do. Many companies don't want an outside advisor.
Yeah.
When I started this business, nobody had an outside advisor. And now some companies understand that generally speaking, you bring in an advisor, the whole process will cost you less than the
Yeah.
cost of the advisor. So, in fact, I'm a cash flow positive buyer. But other
Yeah.
companies, if they've got people who've been through it all a number of times, they'll go it alone.
Yeah.
The job only works if the company actually wants the help. And if they don't, great. I exist, or my business class five group exists, not me, but class five group exists to help those companies that want help. And we think that they
Yeah.
will be better off if they engage with us than if they don't. But we are fully supportive if they want to go it alone. We just want institutional and retail investors to be happy with the IPO shares they buy.
That sounds so much better because I thought at the start that it's Class B group.
Oh, no, class five group, class five.
Class 5 sounds way, way
Yeah,
better.
we're named after Whitewater Rapids, and Whitewater Rapids are
Yeah.
ranked class one to I think six, but nobody can go down six. But class five, they say you're best off with an experienced guide in the boat with you, and that is where we are. We are the experienced guide in the boat
Yeah.
with management as they go through the process.
Interesting. What are the most common misconceptions about companies going? Maybe for the companies who wants to go do an IPO, what's the most common misconception that they don't know?
Oh gosh, there are many. It's important to know that it's challenging to go public,
Yeah.
it's more challenging to be public. It's not about the IPO, it's about what you
Yeah.
do afterwards. I think there's a misconception that if you hire a particular bank logo, you'll be better off. The answer is hire the bankers who understand your company best. And I think often companies are overly optimistic about their forecasts and
Yeah.
need to understand that the cost of missing is enormous. So don't miss.
So there's actually an actual benefit to downplaying your forecast.
To being as sure as you possibly can be that you're going to
Yeah.
hit those numbers.
Very interesting. And what's the importance of market timing with IPO?
You can't time the market.
Yeah.
You absolutely cannot time it. I would not try to go public the last 2 weeks of August or
Yeah.
between, I don't know, December 15th and January 3rd because people are on vacation and you want more people paying attention. Other than that, you cannot time the market. You can start thinking it's a great time to go public and something can change.
And since we're nearing the end of the podcast, do you have any advice for any companies that wants to go IPO?
It's a step, it's a financing step. Uh, if you really want to become a public company, Look at the other companies in your industry that are already public. See how they talk about what they're doing. See what kind of numbers they report. It's a good place to start. Is looking at those who have gone ahead of you to
Yeah.
see how they're running and talking about their businesses. And the second thing is don't get over your skis on valuation too early.
And do you have any general advice on life?
I only worry about the things I can change.
Yeah. And again, thank you for joining on the podcast. Where can people find you?
Oh gosh, well, we are the Class 5 group, and it is a V, so www.classvgroup.com. I am on LinkedIn sometimes, and I guess those are probably the two best ways to reach me. Again, our website does have a submission form, so
Yeah.
that's why, and my email address is on the website. So I think those are probably the best approaches.
Again, I just want to thank you for joining us on the New World Podcast.
Thank you so much for the opportunity, and it's been fun and hopefully useful to somebody.
That's all for today's episode of the New World Podcast. We have explored some fascinating topics with our amazing guests, shedding light on the upcoming New World. If you enjoyed today's episode and today's discussion and want to stay updated the future episodes, don't forget to hit that subscribe button to the podcast. And if you found value on what we have discussed, please consider leaving us a review on your favorite podcast platform. Remember, if you have any questions or topics you'd like us to cover, or if you are interested in being a guest in the future, please feel free to reach out to me via LinkedIn or email me at john.paul@aicinix.com and add New World Podcast, all capital, in the subject line so I can see it. I always love hearing from our listeners. And don't forget to check out our amazing guests. You can find more information about them by the contact details we provided earlier. Again, thank you for tuning in on the New World Podcast. I know your time is very important, and I try to always make the next episode better than the last. Until next time, keep learning, keep growing, keep innovating. This is John Paul Flores signing off from the New World Podcast.